How attractive do China fixed income markets look to you, given the relative positive real rates there?
They look very attractive. So I'll get into some moderately more complicated stuff shortly. But the opening point has to be that 3% or 3.2% on the 10-year is just quite a high number by global standards. So for global investors trying to solve for income, solve for yield, when you look at the different rates available around the world, there's still an awful lot of low numbers, even negative numbers. So the first kind of trivial but nonetheless important point is that yields in China are higher. And what that's leading to is this currency tailwind. So in an unhedged portfolio, in an unhedged positioning, the yield one is actually receiving in global currency terms is higher with this RMB strength that we're seeing. So we think that the CGB market is increasingly attractive for global investors, still frankly struggling to solve for this difficult challenge of how do we solve for yield, which we think is going to continue as we expect negative real rates, to your point, negative real rates in the US and elsewhere to persist for maybe years to come.
Is that likely to change at all in due course? If not now, maybe 6 months hence? What do you think?
No, we don't think so. So we see this policy revolution, the blending of fiscal and monetary policy working very much closer together for really social harmony reasons. And we think this is a fundamental change. Hence, we call it a policy revolution that we're seeing throughout the West, most importantly in the US, of course, with the Fed to some degree, the world's central banker. So we think this new nominal framing is going to continue to see the Fed with the new interpretation of the mandate, as I have mentioned, with this new framework that they have, continuing to be very slow by historical standards to take action. So we think this combination of nominal GDP picking up, inflation picking up, and yet rates staying somewhat lower because the Fed is staying rather stable, we think is going to continue for quarters, and as I say, for even years to come in terms of real rates being the backdrop that negative real rates, being the backdrop that we all have to contend with.
Sure. So wouldn't that completely debase the dollar and bring down its position as the world's top reserve currency? Because we were having this discussion, Christine Tan from our team was having this discussion with Ray Dalio earlier on talking about how the shift may happen Asia side, with the yuan leading the move on that front. But you're largely going to see a lot of money rather move in this part of the world because of that devaluing of the dollar.
So, look, I think that the dollar's not going anywhere. It is still the global currency, and I don't think that's going to change for a long time, decades, I would think. But to your point, the problem is, the big portfolio problem is developed market government bonds don't give you what they used to. That's particularly obvious in, I guess, some of the European bonds with negative yields. But even in the US, the attraction, when we compare to history, is much lower, both in terms of the yield in the screen and the potential risks of the currency perhaps stable to somewhat lower over the years ahead. So what that's leading to, quite naturally, is global investors having to look further afield in terms of what would have been the historic US Treasury allocation, to look further afield, both in terms of asset class and geography. And I think very clearly, Asia is pretty high on the list, towards the top of the list of areas which are interesting. And we're seeing that in the flows. And I think that's going to continue, and if anything, accelerate in the months ahead as this paradigm, we think, will continue.